the background factor as well. But our focus right now is on this trigger point, because in the past, when you look at those two parabolic moves, it's what caused that. Okay, what technical signal? Because already silver was in an uptrend, so it's not like it started a bull market then. It had already been in a bull market. What caused it to accelerate is the key, and we think it was this spread relationship caused the flow of money to go into silver, because when it broke out, it woke people up, especially people on the industry side. But silver right now is vastly undervalued historically to where its normal price is, even in a commonplace year. Like I said, 21 of the last 50 years, it's been at least 2%. Didn't even require a bull market most of those times for it to be there. We're at 1.2. Okay, so wake up. You've got a situation here that is pending, and it looks like it's explosive. And it will happen not slowly, but it'll unfold so quickly. Now, you've got to also be aware that in the middle of both of those moves, where we've been up like 5-6 months vertically, there was a 1 month phenomenon of a correction that fooled people. So like after about 3 months of upside gush, you get this month that says, oh golly, I made a top, okay? Don't count on it. Now also there's another issue. Well, where might silver go? When we do a study of the logarithmic percent gain, once that spread broke out, where was silver then? What percent did it gain over that next 6 months? Well, it was different. 79 to 80 was far more on a percent basis than it was in October 2010 to April 2011. But they were both very dramatic, obviously. If we then take those logarithmic moves, not point value, not dollar value, but the percent scale move of each of those swings post the breakout in the spread, how much did silver gain? And you lay them on top of the current chart, it argues that at minimum you're going to see $100 in the next 6 months, and you quite likely could see $200 in the next 6 months. The issue will be, in my view, where are you in that first half of that surge? In other words, if it takes us 3 months just to get up to, let's say, $70 or so, and then you have a correction, then maybe in the next 3 you only go to 100. But if all of a sudden we find that in 3 months, the first half of that move, you reach somewhere around 100, then watch out. There's a potential we could go to a couple hundred. And by the way, in real dollar terms, as I've said, based on the degradation in the money unit. If silver were 200, it'd merely be matching something like that 1980 peak. So, ponder on that.
Yeah.
I think we're sitting on a unique situation here.
You give me a lot to ponder about here, Mike. That was about lost for words.
Yeah.
Is there anything else?
You go to the next page, and I'll show you. I'll show you the chart. Here's the 2008 move, for example. Spread chart is the top one. It shows the same ceiling type action that prevailed for a couple of years, just like ours has prevailed since 2022, 2023, 2024. The highs were all at that 1.31%. Well, back then it was a different level. It was like 1.6%. But there was a ceiling on the spread, the top chart. And we've circled the green point where the months that broke through that ceiling on the spread relationship between gold and silver. And it's at that point where price went vertical. And then below it, we've posted the monthly price chart of silver and the monthly price chart of gold at that point where the spread broke out. And gold then was like 1,300, and then, by the next 6 months, it reached up to about 1,580 or so. Nice move. But silver went from 20-something dollars to 50. Far more vertical. Ultimately, gold went up to 1,900, but that was a more laborious part of the move. But in the next 6 months, silver left the page, and gold continued up nicely. But that spread announced the point of the rocket launch in silver. I think we're at the same point now where silver back then, between 2008 and 2010, had been going up nicely. It went from, $9 up to 20-something. Nice percent move, but it was laborious. It ceased to be laborious when that spread broke out. Silver just took off like a rocket. And therefore, we're highly focused on what that spread is doing, because that was the signal indicator in 79 and 2010 that silver's going to go berserk. Right now, a lot of people are looking at gold and think, well, gold's going ridiculously. It's, look at the huge amount of dollars up. But actually, in net terms, it's still not, it's approaching halfway of what happened in 79 to 80 and what happened in the 2000 to 2011 bull market. They were both eightfold gains from prior bear low to prior bull high. And ultimately late in the move, you understood why. Oh yeah, okay, now I understand. First took asset class movement out of a degrading asset that had been bubbled and it broke. The money went somewhere, usually went into T-bonds or gold, or both. This time it's primarily gone into gold. T-bonds have been in a lateral range for 3 years. And that's its primary driver. And we're not even close to the metrics, the dimensionality of those moves. So people who are arguing, they're looking at a price chart, oh my gosh, this is too much, too fast. You're looking at dollar terms, look at percent gain. Gold has to go to $8,500 to match the percent gain that it had in the 1980 peak versus its 1976 low, or from its 2001 low to its 2011 high, eightfold move. We'd have to go to 8,050 because our bear market low was 1,050, okay? So we're not even started in terms of catching up to those. And I think a lot of people miss that. And the reason is those basic long-term underlying asset flows. The Fed creates degradation of money, the money goes somewhere. And when they accelerate the degradation of money and the investors finally decide, I'm not going to keep playing the game we've been playing because I perceive risk, stock market, they move it somewhere. And I think that the place they're going to move it now, more so, is into gold and silver, but also into basic commodities. Commodities are vastly underpriced historically to themselves and to other asset categories. Like the Bloomberg right now is around 104 or 5. Its high in 2008 was 237. Okay, so we're not even halfway to it. So anyway, this is the main driver. It's not so much a specific thing. It's the broad context. And yes, some of these specific things help explain that. And right now, certainly the stock market doesn't care about, quote, economics. It cares about, a bad number, bad economy, great, Fed's going to print. Well, that drugged out game historically never continues. There's a point at which it finally breaks on its own. I think we're there. Our technicals say do not trust this stock market. A new high by 10% by the S&P over the January high. You wobble back down a few more percent points, you're going to go back through that high. And then people will say, I thought we had a breakout. And that's when the panic's going to hit, meaning that people in the stock market who felt comfy will suddenly feel uncomfy. And they'll go to where, it's comfort.
People often ask me, what's the signal? What's the trigger? They'll say, Michael, we've been in a bull market in metals for a few years now. Gold's up, silver's steady. But when does the real move start? And that's the right question, because silver doesn't move in a straight line. It meanders, frustrates you, lulls you into boredom, and then one day, boom, it's gone. It doesn't walk higher, it leaps. Now, to understand what's about to happen, you have to think like a technician, but not the kind that obsesses over daily wiggles and RSI readings. I'm talking about structure, the spread relationship between gold and silver. This is where the story begins, because historically, it's the breakout of that spread that lights the fuse for the parabolic phase in silver. Let me explain what I mean. Take an ounce of silver, divide it into an ounce of gold, and express that as a percentage. Right now, silver is trading around 1.2% of the gold price. That's abnormally low. In fact, it's half of what it used to be in normal years. For 21 of the last 50 years, silver has traded at 2% or more of gold's value without requiring a bull market to do it. In other words, silver doesn't need mania to double from here, just mean reversion. But what happens when the spread actually breaks out? When silver starts outperforming gold in a big way? That's when money floods in. You can see it in the data. Every time the spread crosses a key ceiling, capital rotation accelerates into silver. It's like the market suddenly wakes up and says, wait a second, this thing's been mispriced for decades. The first time that happened was in 1979. Gold was already in a bull market. It had been rising since '76. But once that spread broke out, the move turned vertical. Silver went from $8 to $50 in 6 months. Not years, months. Then it happened again in 2010 to 2011. Silver doubled in less than half a year, from $25 to $50, even as gold moved steadily higher. That's what we're seeing right now. The exact same structural setup. The spread's coiling beneath resistance. Momentum is pressing against the ceiling. The moment it breaks, and it will, you'll see the same reaction as 1979 and 2010. Industrial users panicking, investors chasing, miners exploding. People look at their screens and think, silver's already up 40% this year, maybe I should take profits. Number. You're not seeing the big picture. You're looking at arithmetic charts, linear price charts, which distort the reality of percentage moves. If you switch to a logarithmic scale, you see something different. We're barely halfway to where those previous cycles began their parabolic accelerations. Let's talk numbers. When silver went vertical in 1979, it surged 500% in half a year. In 2010 to 2011, it gained about 150% in 6 months. If we overlay those moves, not in dollar terms, but in percentage terms, on today's chart, we get some fascinating results. Even if silver matches just the 2011 move, we're looking at $100 in the next 6 months. If it repeats the 1979 trajectory, $200 is on the table. Now, before you roll your eyes and say, that's impossible, remember this. In real dollar terms, $200 silver today merely matches the 1980 peak once you adjust for inflation and the dollar's degradation. You're not even exceeding historical precedent. You're just catching up. Silver's not going crazy. The dollar is. And that's the fundamental truth the financial media won't touch. They'll say gold's too high, silver's overheated. They're measuring price in the wrong denominator. You don't measure value in a melting currency. Meanwhile, beneath the surface, the emotional structure of the market is primed. Retail investors aren't paying attention yet. Institutional money is nibbling, but not committed. The Fed is cutting rates again, and the crowd thinks it's a sign of control. But every major silver rally in history, 1980, 2011, began during rate-cutting cycles, not tightening ones. Because the moment the Fed cuts, they admit defeat. They tell the world inflation isn't transitory, it's structural. Once that realization hits, capital flees paper and runs toward metal.
Imagine what it's going to do to some of the miners. Now, the silver's in a unique position fundamentally because its primary production doesn't come from the silver miners.
No.
And therefore, when its price goes up, it doesn't entice a massive inflow of new production. Right. Why? Because most of the mining comes from lead and zinc. And the miners who get that stuff out of the ground aren't primarily focused on the tertiary market that they're also bringing silver out of the ground. It doesn't cause them to go mine more heavily and aggressively just to get the silver because it's a minor portion of their output. You get the point. So it's got a unique supply-demand situation as well, but we don't get into that. That's just a background feature. And I just think silver's going to reprice itself at $100, $200. And yeah, you're going to get sell-offs from there, but you ain't coming back to 50 or 20 or 30 or anything like that. You're going to be in a new reality. Silver's going to be living at a level that just has been living in the last 50 years, between 50 and 10. It's going to be a new level it's going to be living at. And I suspect it's going to be like 100 to 200 somewhere. The key is to catch that move. And I do not think it will be incremental. This happened in 2000 and also 2007 where you made a high. In fact, we turned bearish in January 2000 and the market made a new high in March, marginally. Pull back again, went up, made another new high monthly close in August. It didn't really start to fall apart till 2001. And this is a year after momentum said, you're no good. And sure enough, if you get out of the market in January, yeah, you missed another 5, 6, 7, 8% of laborious BS action, up, down distribution. And then you had a collapse that, killed you. Same in 2007. We got to a target zone minimally in May, had a sharp pullback into the summer. And again in late 2007, in September, the Fed cut rates finally. Okay? That caused the final rally that lasted into mid-October. Lasted for a month, buying the cut news. That was the top. What did it do? Silver took out the all-time highs. The May high of 2007, which was what? 1550. What was the high in 2000? 1550. A dual top was broken through because the Fed cut rates in September 2007, laborious stopping action in 2007, because of a Fed rate cut. Why? Because they knew the mortgage crisis was coming, although they denied it. And the market partied. And that was the top, a triple top price breakout. 1550, 1550, then in October, 1575 of 2007 was the top. So it's laborious. We're going through the same thing right now. The problem is, from a momentum perspective, if you get the chart and look at it, price has punched out the January high on the S&P or the February high, and momentum has not. When you look at the momentum chart, you say, ooh, it's up under the structure that it broke. So if the bottom chart were a price chart, you'd be wanting to sell. The price chart looks like I'm going to go up forever. The momentum chart says, no, you're not. We have a debate here. This is what often happens technically when you're at the top. Momentum will break down first, price will break down second. Momentum usually tells you ahead of time. Right now, momentum has already told us, don't trust the new highs. They're likely not sustainable. And that when that money flows out of there, that's further fuel for gold and silver. I think you just got to be, if you're in the stock market, and that's the only thing makes people smile right now, the average middle-class guy or guy's got a retirement account, he's a retired government employee, hey, at least my 401k and my retirement account's up on the year. It's not up much, by the way.
Now let's go deeper into the trigger itself. Because this isn't a story about hype or headlines. It's about math, structure, and the invisible hand of momentum that's been coiling beneath the surface for years. What most people don't realize is that the silver market has been in a slow-motion bull since 2020. The problem is, it's been disguised as frustration. Every rally has been capped, every dip bought just enough to keep hope alive, and every sideways grind has exhausted traders. That's how the market shakes out the tourists before it rewards the believers. But the real catalyst, the ignition point, comes when the spread between gold and silver finally breaks out of its containment. That spread has acted like a lid for nearly 3 years, with each rally running into the same ceiling around 1.31%. Every time silver starts to outperform gold, it gets swatted back down until one day it won't. When that breakout happens, it's not just a chart event. It's a signal to the global flow of capital. The old ratio is dead, and history tells us exactly what happens next. In 2008, you had the same structure. Gold was recovering from its financial crisis low, silver was lagging, and the spread formed a long, tight ceiling. The moment that ceiling broke, the exact month, silver went vertical. The top panel of that chart from my research shows it clearly. The spread broke through resistance, and that same month, silver jumped from the low 20s to the 30s, then exploded to $50 in just 6 months. Gold moved higher too, sure, from around $1,300 to $1,580. But the silver move was violent, exponential, emotional. And that's precisely the setup we're facing again. Since 2022, silver's been hammering at that same kind of ceiling. The last 3 years have been one long coil of energy, pressing against resistance, with investors yawning and algorithms trading the same narrow band. But momentum, the underlying slope of that spread, is telling a different story. We're right at the edge. The structure is complete. The spring is wound. When that spread breaks, when silver finally starts outperforming gold in earnest, the first reaction will be disbelief. Traders will think it's just a head fake, a too much, too fast situation. Then they'll realize what's really happening, that money is migrating out of financial assets and into tangibles, and that silver is the highest beta expression of that shift. Now let's talk magnitude. We ran the numbers. In 1979 to 1980, once that spread broke out, silver's logarithmic percentage gain in the following 6 months was enormous, several times larger than in 2010 to 2011, but both were parabolic. If you take those percentage moves, not the dollar amounts, and overlay them on today's chart, it argues for $100 minimum in the next 6 months and $200 in a best-case scenario. That sounds wild until you remember inflation. If silver were to reach $200 today, in real terms, it would merely be matching its 1980 high. That's how much purchasing power the dollar has lost. In other words, $200 silver in 2025 is simply 1980 silver adjusted for honesty. And here's the thing. This won't unfold gradually. When that breakout comes, it'll unfold in weeks, not years. People have forgotten what real panic looks like because they've been trained by 15 years of central bank babysitting. Every dip bought, every crisis bailed out, every shock muted by QE, but the Fed has finally reached the point where their fix has become the problem. The debt's too big, the deficit's too constant, and the market's too addicted. When rates get cut again, it won't be stimulative, it'll be confessional. The cut will tell the world that inflation isn't transitory, that fiscal policy is out of control, and that the currency itself is the variable. And that's when the flood into real assets will begin. Now you might think, surely the stock market will be fine. The Fed's cutting, right? But look deeper. Every major top in the last 50 years, 2000, 2007, 2021, was accompanied by the same pattern. Price made a marginal new high. Momentum did not. The divergence widened and then came the reversal. We're seeing that right now. The S&P has pushed 10% above its January high, but momentum's rolling over. That's what I call the whisper before the fall. If you strip away the headlines, the soft landing propaganda, and just look at the math, corporate earnings are stagnating, consumer credit is maxed, delinquencies are spiking, and yet stock valuations are near record highs. That's a perfect setup for what technicians call a distribution. Top money is quietly leaving the back door, while the front door crowd is still cheering. When that crowd realizes the exit's already half empty, that's when panic begins. And that's when silver ignites. You'll see it first in price, then in tone. Suddenly, CNBC will run segments asking, "Is silver the new Bitcoin?" Jim Cramer will call it frothy. Your neighbor will start texting you about coin dealers. And that's when you'll know the vertical phase has arrived. Now let me be clear. There will be corrections, sharp, heart-stopping drops along the way. Every parabolic move has them. In 1979, there was a one-month pullback right in the middle of the vertical surge. Everyone thought it was over. Then it doubled again. In 2011, same thing. January correction, then an even bigger run into April. So if you see silver pause for a month, don't be fooled. That's not the end. That's the intermission before Act 2. The key question now is, what happens after? Where does silver live once this is over? My view, it establishes a new normal, a new price reality. Silver will not return to $20 or $30. It will find equilibrium somewhere between $100 and $200, because at that level, it will finally reflect the degradation of the currency and the global repricing of commodities. And once that reality sets in, the world will look at silver differently, not as a trade, but as a monetary barometer.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.